Let's take a closer look at valuation and loans. There are two separate ways that we're going to look at for valuation at this point. The first is income flow method. Use this if you just need to get a quick down and dirty number. Someone makes you an offer and you want to quickly determine if you want to consider it further. So we're going to walk through this together, and the information is provided to you on that worksheet that I linked. So follow along and do the calculations yourself in Excel so that you can see how it works. Okay, the first thing it asks us is to determine the average earnings before taxes for the last 3 years. So we have our last 3 years here, and we determine average in Excel by equals, average, and then the numbers that we're going to be using. So we come up with 44,985. Then you add owner income for the last year to that figure. That gives you a pretty steady income for what you can expect. You might also want to verify that owner income isn't unusual before you go further. Once you've established your total income, then you want to subtract any unpaid expenses, because those are things that are outstanding. Maybe they have money that they own or that they owe to vendors or payroll or something like that. Then that takes us to just under 80,000. You take out existing depreciation because they would have the right to take that themselves on any equipment. If they're going to forego that right, that would be part of the negotiation process. But that takes us to about 71,844. We take out any one-time only income, so maybe they did a deposit for their rent or for an electric bill or something like that. They would get that back when the business sells. So that puts us at $70,843 that the business is worth. When we multiply by 3 to 5, because you're expected to recoup your investment within 3 to 5 years, we find the value of the business between $212,000 and $354,000. So if they were asking $450,000 for this business, you would know that you didn't want to take it any further. So that's the income flow method. It's just quick, add, subtract, multiply, and you're good. Our next format is called free cash flow method, and this is to tell you how much you have available to purchase with, and it also gives you some guidelines for if you're going to expect a return on investment. And of course, why would you buy a business if you weren't expecting a return? But it gives you some guidelines for how much you can expect. So let's walk through this one together as well. So our first item is our net after-tax earnings, and that includes our owner's salary, so $96,000. Then we'd multiply that by the number of years that the loan is going to run. So 96 times 5, and let's call that step 1, equals 96 times 5. And that's $480,000. So now we want to take out our down payment. So we take this total amount equals 480, and we subtract the down payment, which gives us 415, and we can see that on the PowerPoint slide. So this is the total amount available for principal, interest, and owner incomes, or owner return on investment. let's see what that translates to per year. So if we take $415,000 divided by the number of years that the loan is going to run, we know that we have $83,000 to work with. So our next step is to determine the return on investment. Now the only money we have currently involved is the down payment. So we take that $65,000, and multiply it by the expected return on investment that we want for that money. And that gives us $13,000. So taking $83,000 and subtracting what we want out of it for our income takes it down to $70,000. Well, we know that $70,000 is per year, so now we're going to take the $70,000 and multiply that times the number of years that the loan is going to run. So that tells us that we have $350,000 to work with. We also know that it's $5,833.33. I'm just going to round that. Because we've taken, and I'm going to double click so you can see it, I've taken the $350,000 and I know that that's a total of 60 payments. So each payment is $5,833. Our final steps are to determine the amount that we'll be able to borrow, how much it's going to cost us overall, etc. So let's take a look at that. We're going to look at 8% interest and 10% interest. So that will change our numbers. First thing we want to do is we want to figure out our monthly payment. To do that, we're going to click on FX for our function, and we're going to find the PMT, or payment function, and we're going to say, okay. We're going to start with the rate. Our rate is 8%. We're going to make 12 payments in a year, so we type in 12. Next item on our list, total number of payments. Well, that's 60. And then the present value, so how much we can actually borrow. There are other ways to be able to determine this, but I'm showing you this way because chances are you're going to look at a wide variety of numbers, and this is the easiest way to look at a wide variety of numbers quickly. So we know we have a total of $350,000 including interest. So before interest, I'm going to say maybe $300,000. And then say, okay. Oh, that's too high because my total paid with interest, in other words, my monthly payment times my total number of payments, is more than $350,000. So now I can go back and play. I can say 300, let's see, that's too much. So let's take it to 285,000 and see where that takes me. And that puts me at 346. So I can actually go up a little bit. Let's try 7. Oh, right there. So I know I can borrow $287,000, and that will be where I can max out at my possible allowance. Let's try it at 10%. We go back to function, we click on payment, okay. This time our rate is 10%. We still have 60 payments. And our amount is going to be lower because we're going to be paying more interest. So let's see, what shall we start with? Let's try 275. and okay. And what did I do wrong? 275. Okay, what I did wrong is I didn't divide by 12 months. So when I adjust that, my number goes back in line because, wow, that was way off. So now I know, oh, wait a minute, that's too high. So I need to actually drop that. Let's drop that to 274. And 349,301 brings us back in line. And that tells me that I can borrow 274. So at 8% interest, my principal is $287,000. At 10%, it's only 274. So 274,000. So that difference in interest rate is pretty significant in my borrowing. The total purchase price, $352 versus $339. So that's how you figure these numbers. And let me know if you have any questions.